In today's video, we will discuss dividend investing for long term. The concept is pretty simple. Let's figure out the dividend investing. It is actually the distribution of a company's earnings to its shareholders and is determined by the company's board of directors. Dividends are often distributed quarterly and may be paid out as cash or in the form of reinvestment in additional stock. The dividends significantly boost stock investing profits, provide an additional gauge for fundamental analysis, lower total portfolio risk, offer tax benefits, and help to retain capital purchasing power. Companies that raise their dividends payments year after year are less volatile than the market as a whole. Some corporations respond to inflation by increasing dividend distributions. Furthermore, dividends income might help smooth out a stock's total performance. After paying its creditors, a company uses a portion or all of its residual profits to pay dividends to its shareholders. However, if a company needs more cash or capital for reinvestment, it can forego paying dividends. When a corporation declares a dividend, it also establishes a record date, after which all shareholders registered as of that day are eligible to receive dividends payments in proportion to their shareholding. For example, if a company issues a stock dividend of 5%, it will pay 0.05 shares for every share owned by a shareholder. If we talk about dividend investing, then dividend investing is the practice of purchasing stocks in a company that pays out regular cash dividends to shareholders as a reward for owning their stock. TIPS can provide a continuous income stream from your investment on top of any growth in the value of your portfolio's stocks or other holdings. Dividend investing for a long term can be a great investment strategy. Dividend stocks have historically outperformed the S&P 500 with less volatility. That's because dividend stocks provide two sources of return: regular income from dividend payments and capital appreciation of the stock price. This total return can add up over time. Dividend-paying stocks can be a great strategy to supplement your income and increase your portfolio's growth potential at any age. However, investigate the company's total financial condition before investing, not simply its dividend yields. The widespread notion is that dividend equities are only appropriate for retirees or risk-averse investors. That is not correct. When investing, consider buying dividend-paying companies to gain long-term rewards. In addition, dividend stocks, particularly those in companies that raise their dividends regularly. Later in the video, we will talk about how dividend investing for a long term can be beneficial for shareholders, so make sure to watch the video till the end. Now, let us discuss some benefits of dividend investing for the long term. Passive income. One of the primary benefits of dividend investing is the ability to generate passive income. An investor receives regular payments that can assist in supplementing their income as long as the company continues to pay dividends. Many companies pay shareholders dividends to distribute earnings and encourage stock ownership. Investors can utilize them to generate passive income and build wealth over the long term. Dividend rates are per share, and the dividend yield is expressed as a percentage of the share price. Dividends pay a fixed number of benefits on a predetermined month in advance. They can provide tidy sums of income for people interested in living on investment income over an extended period. Dividend investing preserves purchasing power of capital. John D. Rockefeller once said, "The only thing that gives me pleasure is to see my dividend coming in." Dividend investing for the long term also helps in another area that investors frequently overlook: the impact of inflation on investment returns. For an investor to earn a genuine net gain from an investment, the investment must first generate a sufficient return to compensate for the loss of buying power caused by inflation. For example, If an investor holds a stock that improves in price by 3% over a year, but inflation is at 4%, the investor has lost 1% in purchasing power. If, on the other hand, the company that gained in price by 3% also produces a 3% dividend yield, then the investment has successfully returned a profit that outpaces inflation and represents an actual increase in purchasing power for the investor. The excellent news for dividend-paying stock investors is that many dividend yields outperform inflation. You can earn a return no matter what stock prices are doing. Adopting a long-term, value-oriented dividend investment mindset makes it much easier to grow your wealth and income over time. Investing in dividend growth stocks helps to separate long-term total returns from market volatility. Instead of fretting about your portfolio's performance on any given day or year, focus on its dividends. After all, they will account for a sizable amount of your returns. It isn't easy to lose money in the long run, as long as a company's core investment thesis stays intact, allowing it to grow its dividends sustainably, unless you let your emotions stand in the way of a rising revenue stream by selling for emotional reasons. Compounding works to your advantage. Dividend investing for the long term allows you to take advantage of compounding, or the ability to reinvest your profits, e.g., dividends, over time, to generate even more significant profit potential. Time is your greatest friend as an investor, and being able to reinvest a tip at 3% can make a substantial difference in your wealth come retirement. For example, simply pocketing a 3% yield will double your money every 33 years, assuming no dividend or stock price growth. If reinvested back into more shares of the same stock, your investment would double in almost 10 fewer years. Your investment risk drops. Trying to enter and exit the market at precisely the right time may result in you missing huge up days in the market. For example, according to a study conducted by JP Morgan Asset Management, utilizing data from the 500's most extraordinary swings between December 31, 1993 and December 31, 2013, staying invested for the whole 20-year period would have garnered investors in the broad-based index a 483% return. You must have the 10 most significant gains in that period to have reduced your return to 191%. For example, if you missed at most 30 days during 20 years, your return was less than 20%. The key is that staying involved minimizes your chances of missing out. The key is getting started as soon as possible and staying disciplined to maximize long-term dividend investing benefits. Hope this video was helpful for you. See you in our next video. Remember to like, share, and subscribe. Press the bell icon to get regular updates.